Hey, ladies and gentlemen, welcome to the Pro Series Part 2. What a day in the markets it has been. We're going to buckle down here today and learn a lot. My name is Jeff Cook, like Jeff the Chef. I'll be your host this evening. We're going to just continue where we left off yesterday in Part 1, where we went over the platform layout and kind of some terminology and vocabulary that we wanted to know a little bit more about. And today, we're going to really dive into the three products that Nadex has. So if you're trading at Nadex for the first time, really tune in, hopefully you'll get a decent understanding of these three products once I get done with this webinar. And then if you're trading here already, hopefully this will be a little bit of a fine tuning on just making sure that you're clear on how three of these work and when you might want to use one over the other. So with that being said, thank you guys for joining. We have a little over 100 attendees right now, which is awesome. This should be fun. So I'm going to go ahead and get started. A couple of things I need to address here before I dive into the bulk of things. Hopefully you guys can see everything. My name's Jeff. As I explained, I'm going to be your host. I run these series every Tuesday, Wednesday, and Thursday at 6 p.m. here in Chicago, Illinois. I've been here for about 4.5 years. I've been trading for about 10. I'm 30 years old. So some of you are younger, some of you are older. At the end of the day, we're all trying to make moves in the markets, and I like to help out new traders, and I just think trading is cool. So, looking for supplemental income or or long-term income, whatever the case may be, I think it's just great to have some money working for you. So I like to help out new people in learning Nadex and learning the platform and learning trading as a whole. So that's a little bit about me. Risk disclosure. So a couple of things. Just take a moment, read through it if you can. A couple of things I'll point out. Trading's risky. Don't risk with money that you can't afford to lose, like your rent money or your food money or anything like that. It's super fun to trade, but it is not fun to trade with money that you can't afford to lose. So don't do that. Also, past performance is not indicative of future results. So that's really what the risk disclosure is saying. Take a moment. I'm going to go ahead and continue forward. This here is a disclaimer. Basically, this just is saying that, this is Nadex's property. Don't copy it. It's for educational purposes, and I'll probably say that multiple times throughout this webinar because everything I'm going to be doing is in the demo, and everything I'm doing is just hypothetical. I'm just trying to be educating on like the products themselves. I'm not giving any advice or anything of that nature. Okay. So let's go ahead and get into the bulk of things. So as you see on your screen, we're going to go over the three products here: the pricing, the functionality, and the trade. Some trade examples of all three. I tend to really dive in. For those of you guys that have attended my webinars before, maybe attended part 1, I really dive into a lot of detail. About 3 minutes in right now. I should hopefully be done within 40. So I'll dive in, I'll make it fun, I'll make it interesting, I'll try to be exciting. I'm obviously live, I'm here real time, you can see me, but we're gonna dive in. We're here to learn, and we're here to educate ourselves on these products, and we're gonna be a little bit more serious about just fine tuning our craft here. All right, 3 products: binary options, touch brackets, call spreads. What we're going to do is we're going to learn a little bit more about these products in that order. Before I dive into this slide here, and I'm not going to spend a lot of time on slides because I'm not a big fan of slides. I like to keep it live and fresh. But there are some things that I do want to notate and just make sure that people understand from like a mathematical perspective. But if you guys have questions, feel free to stick around afterwards to listen to anyone that has questions over the course of the webinar. I encourage you to do so. You learn a lot. And I learn a lot as well about you guys. Also, give me a quick shout out from where you guys are from. We have a lot of people on attendees today, so it'd be interesting to know where you guys are from. I'll give you guys a quick shout out. Obviously, I'm here in Chicago, but I'm a Tennessee boy. I have a colleague of mine. His name's Nick. He's here with me every single night. He's my partner in crime. Basically, he's going to be here answering questions, for over the course of the webinar, making sure that all of your guys' questions are answered. And if they're complex, I might stick around and maybe answer them at the end of the webinar. But yeah, feel free to be interactive because he will interact with you. He's ready to go. So let's go ahead and do it. We're going to go ahead and dive into the 3 products that we have here at Nadex. First of all, we're going to go over binary options. Well, that's a lot. If you basically have never traded before, you just want to ask yourself, like, what is a binary? It's a statement. It's a statement with two potential outcomes. So, for example, is it going to rain today? Either it is or it isn't. So that's a binary statement, right? Well, then you think about that for a second. It's a yes/no situation, right? It's either going to happen or it's not. So a binary option at Nadex is that same thing. It's still a statement, but with two potential outcomes, a yes or no, but it's based on the financial markets. So what I want you to do is just follow along the slide with me. Hopefully you guys can see this. My cursor showing up. Cool. Awesome. All right. So a couple of things. I'm going to go through this slide kind of twice and you'll see what I mean, but I'm going to break things down. Again, I'm just going to treat it as if anyone doesn't even know what a binary option is. Okay. So what's a binary option? Follow on the slide. All right. It's a true or false statement. All right. Yes or no. Either the event happens or it does not at expiration. Okay. Each binary option contract has an all or nothing payout of $100. All right. So here's the deal. Will this market be above this number in an hour and 38 minutes? This is where it's currently at. If yes, you're a buyer. If no, you think it's going to finish equal to or below 26,110 and you'd be a seller. All right. So you see how it's a true false statement, a yes or a no. I either think it's going to finish above 26,110 or I don't. I'm a buyer or I'm a seller. See how that binary clicks in there? A couple of things. So you have, like, with a binary option on Nadex, it's scaled out of $100. So it's on a $0 to $100 scale. All right. One person thinks it's going to go higher. One person thinks it's going to go lower relative to that strike price. All right. Now the binary price that you see here, it's going to change as to the relationship with the underlying market right here, the indicative price, 26,129 and some change. All right. And also the time left. So if this market were to keep going up, obviously the likelihood of it settling above 26,110 gets higher and higher. And with that probability comes greater value, right? And as this number here goes down, right, then the probability of it settling above 26,110 would become lower and lower. So the value of your contract would go down if you were a buyer in this contract, right? Also, time it plays an element here. So in an hour and 38 minutes, you're right or wrong. Okay. And it's important to understand that with time left, I think about like a football game, really. Like, if I'm up a touchdown in the first quarter versus being up a touchdown in the fourth quarter, there's two different avenues there. With 3 quarters left, being up a touchdown isn't that much. There's a lot of time value there, right? But with only a couple of minutes left or 5-10 minutes left in the game, there's a lot less time to score that touchdown. So the probability of success or failure, essentially is changed with time, right? Basically, like with a binary option, you're a binary buyer if you agree with the binary statement. So when I say true, false, I'm saying, do I think Wall Street 30 for the month of June will be greater than 26,110 at 4:15 p.m. today or tomorrow, all right, or for this example, right? And if I think that's true, I do think it's going to be greater than 26,110, then I'm the binary buyer, all right? And as a binary buyer, you want that binary trade price to expire at 100. So when you think about buy low, sell high, well, the highest a binary option can be worth is $100. So in this example, if I risk 74.75 here, a max profit, well, I put a 72 max loss in there. I put a limit order of 72, and I'll go over that in a second. But if I'm willing to risk 72, my max profit is 28. 72 and 28 equal $100, right? So as a binary buyer, I want this contract to expire at its greatest value at 100, all right? And vice versa as a binary seller. So if you're a binary seller, you're looking for that bid to go lower and lower and lower to 0, right? If you disagree with that binary statement, no, I do not think that the Wall Street 30 will be greater than 26,110 in an hour and 38 minutes. All right. you're selling at a binary trade price and you're wanting it to expire at 0, right? You're wanting this to go lower and lower and lower and lower. Sell high, buy low, right? On a general term. Again, not advice, just think about it from an educational and theoretical perspective. Buy low, sell high, buy low. All right. Now, at expiration with the binary, if the indicative price is fractionally above the strike or more, then the binary buyer will receive that $100 contract settlement payout, right? So with the binary option, you're right or you're wrong. It's a yes or a no. It's true or false. So if it settled at 26110.01, then it settled above 26110. If it settled at 26150, it settled above 26110. The payout stays the same. It's $100 at expiration, right? And if it's lower, right, than that, then your contract is worthless. If it was equal to 26110 or less, even if it was equal to 26110, you would not get the payout for that contract. You'd get a $0 payout, right? Because that statement would be false, right? So think about that. A couple of other things I wanted to touch on as well is that binary options, like, at least I think it takes the emotion out of trading. So when I think about, like, I mean, thinking about the market today, if you're in any calls or any markets thinking about it was going to go up. I mean, the markets got hit pretty hard, after the Fed meeting today. We'll take a look at the S&P 500 futures here in a little bit. But here, a binary option, your max loss and your max profit scenario, right? Whenever you're going into your trade. So you don't have to worry about stop losses in the sense of the fact that that I know what my max loss is, I know what my max profit is, and then with all three of our products, you have the ability to close your position before expiration, which allows you to manage your trade as well. We'll go over that more in detail a little bit later, but trust me, from an emotional perspective, this product is pretty awesome when it comes to just knowing your worst case and best case scenario. All right. And no other instrument does that, and that's really what's awesome about it. Couple of things. I went over this slide a little bit, but basically if I were to break it down, what do we got here? 12 minutes. Okay. So if I were to break it down, essentially I broke it down a little bit earlier, but if I was a buyer, I want this market to finish above 26,110. It's at 26,129 now. We'll dive into this deeper a little bit later, but it's already above the strike. So like if you were to get into this contract, you already have an advantage. So when I think about a binary option, I think about advantage. Who has the advantage, right? And that strike price is your line in the sand, right? So if you're a buyer, you want it to be above it. If you're a seller, you want it to be equal to or below it, period. Right? And as the likelihood of either one of those scenarios change, the value of your contract is fluctuating between $0 and $100, right? With variables of like time left and also where the market's at relative to the strike. If you were a seller, you just flip that on its toes, right? You're saying, okay, well, the market's already above 26,110 right now. I would expect it to maybe drop a little bit. In this case, if I was risking 72 on the buy side, that'd be me risking like 28 on the sell side, right? So I'd be willing to risk $28 on the sell side and I have a max profit of 72. So it's just flipped. The seller would be risking less to make more, but they're also at a disadvantage. They have an hour and 38 minutes left and they would need to have this market come down another 19 points and some change, at least, in order for the contract to settle in their favor, right? So that kind of breaks down this ticket a little bit. So hopefully that breaks down like how the binary works, as far as like the scale of 0 to 100. As far as the buy side, you're looking to go up to 100. Sell side, you're looking to go down to 0. If you're a buyer, you're looking at this column over here. If you're a seller, you're looking at this column over here. All right. And that's really kind of breaks down like the functionality of a binary option. And you can trade multiple contracts. You might be you're risking 600 max loss to have a $400 max profit, and you're trading 10 binary options. Or you're trading 1 or 2, right? So just make sure that you're risking relative to your portfolio or your available balance. A couple of things I wanted to dive into just to kind of complement that a little bit. So hopefully you guys should see this here. Okay, cool. You'll see what I'm going to do is I'm going to go to the S&P 500 and then I'm going to go to the daily 4:15 p.m. time frame, right? And then from here, I'm actually going to pull up a chart, and this is a binary ladder chart. And essentially, I'm going to open this up in a new window. All right. Actually, no, I'm not. I'm going to cancel that. Abort. I'm going to go ahead and just keep it in this window here. I'm going to expand these out a little bit. We're going to be going over charts in very much detail tomorrow. Get excited, 6 p.m. tomorrow. I'm not going to dive into it crazy today, but we're on the charts. Hopefully I'm not blocking it with my big head here. All right, cool. So check this out. S&P took a tumble today. Look at there. Oh, buddy. So that's what happened today. Couple of things. So I'm going to throw out some theoretical, educational scenarios, okay? Not giving trading advice here. I'm just going over some theoretical stuff here just to understand like how these binary options are priced, okay? I want to make that very clear, all right? So a couple of things, all right? Hopefully you can see these over here on your screen, all right? And when I'm looking at them, all right, I know where the market's at now, and I'm looking at 5-minute candlesticks. I'm going to change that because we're looking at a daily 4:15 time frame. So I kind of want to know the larger scale, so I just changed my interval to 15 minutes. Now, here are the binaries listed over here on the right-hand side, right? So if I was looking to trade a binary option, I'm looking at all these lines like lines in the sand. Binary ladder chart. This is every step on the ladder. All these contracts expire tomorrow at 4:15 p.m. live, okay? Now, the market is here, 2921.133, and it's going to move as we talk. I have a lot of different binary options that I can choose for this S&P 500. As you can see, if we were looking to be a buyer in any way, shape, or form, and we thought the market was going to go up, okay? There's a lot of different options. Maybe you think the market's going to come up a lot in the next 20 hours, right? And you have contracts that are out of the money where you're risking less to make more. So in this example, market's at 29.21. If I thought the market could finish above 29.35 by tomorrow, large jump there. Granted, it did that this evening, but it would have to come up a long ways, right? But you also got 20 hours for it to do so. There we go. This line right here, that contract right there would cost me around $22. If I'm risking 22, my max profit's 28. Bam. There's your risk on investment, right? Your return on investment, I mean, right? See, that's about a 400% return right there. You're risking less to make more, but the probability of success is also less. Why? Because the market needs to go up. It's currently under this line in the sand, 29.35. We need to be above that if we were the buyer at expiration tomorrow at 4:15, right? But it only costs us 21.75 right now, And by the way, you also have the ability to close your positions early. You can close your position before expiration, right? So you don't have to wait until expiration to be right or wrong. You can be kind of part right or part wrong, right? And trade as that value fluctuates between 0 and 100. There's people that are on 5-minute binaries and 20-minute binaries and 2-hour contracts that may only be in for a couple of minutes, or maybe people trade it daily and they might only be in for an hour or two, but they give themselves the time, that they need to, to create those expectations. But in this case here, out of the money binary, less risk, more reward, lower probability of success. I need this market to come up from 29.21 all the way up to 29.35. Right, we need a big move there, 14 points. Then you got your at the money contracts where you're like, you know what, this market took a big drop today. Maybe you're thinking the market's not really going to move around a lot. You could look at an at the money binary, something like right here, where the market is kind of close to where the strike price is. So right now the market's at 29.21. Hey, I think the market's going to finish above 29.23. It'd only have to come up 2 points, and that would settle in my favor there. You see how the market price and the strike price are very similar, and how the offer and the bid are close to that $50 mark, because there's an equal probability almost. We're still slightly out of the money here for the buy side and slightly in the money for the sell side, but it's pretty close to 50, right around there. And that's because, there's about a 50% chance that the market could finish above that and 50% chance that the market finish below that. And there you see, based on the time left and where the price is currently at. So just think about that advantage, right? And where the market's at, what you need the binary to do. That's at the money, risking around 50 to make around 50, right there. 49.25 to make 50.75. I just need the market to finish above 29.23, just like that. If I was a seller, it'd be the exact opposite, right? I'd want the market to finish equal to or below that strike price, and it's currently just about 3 points below it now. Then you got your in the money contracts. Maybe you're thinking, I don't think the market's going to go any much lower than this contract here or this strike price right here. Maybe you want a little bit of cushion. Hey, this market may come down a little bit, but I ultimately think it's going to settle above, 29.11 as an example, right? So you were to choose that, and you could choose that ticket right there. Here, you're risking more, profits less. I'm risking 77.75 to make 22.25, right? Still about a 33% return on your investment at max settlement payout, but at the end of the day, you're risking less you're risking more on the table, right? And to make less, but the probability of success is higher. I just need this market to finish above 29.11. It's at 29.21 now. It could go up. It could come down to 29.11.1. Stay anywhere above 29.11, I'd get a $100 payout per binary. All right, but I'm paying $77.75 a piece for the buy side. For the sell side, this would be an out of the money sell side here. You see how it's at 29.21. Maybe you think, I think this market's going to go down, and I think this market's going to keep going down or whatever, right? And just as an example, right? Then you might look at the sell side and say, ooh, I could, risk 28.25 to make 71.75, but I got some work to do. I need this market to come down a lot more. 29.21, it's at 29.11. I need this market to come down 10 points or better for this contract to settle in my favor. But the probability of success is low at this moment with time, but we also have a lower max loss and a higher max profit. So just understanding the differences, all right, whether you're being a buyer, whether you're being a seller, whatever you think that market's going to do, right, whatever your reasoning, just understanding the different types of binary options that are available, and even more so, the different time frames that are available. I mean, the S&P 500 has 20-minute binaries, 2-hour binaries, daily and weekly, which is pretty solid. Gives you a pretty good coverage within the week. But you don't see 20-minute and 2-hour time frames here because they're not available at this time, right? So if you were to go to Nadex.com, which I'll do real quick, you can go to markets right here, and you can go to stock indices. You can go to contract specs. I went over this in part 1, but I'll briefly review it again. You can see, I was trading the S&P 500. This is the market that I like. Or, I'm trading the euro versus the dollar. This is the market that I like. Or, I'm trading crude oil. This is the dollar. This is the market that I like. These are your time frames that you have for that market. So we have 20-minute, 2-hour, daily, and weekly. But as you can see, we have a 10 o'clock expiration for our first expiration time. Trading hours, 20 minutes preceding expiration. Our first contract starts at 9:40 in the morning for 20-minute binaries, Eastern, 8:40 Central, right? And then 2 hours start at 8 a.m. Eastern, right? So we don't have those available right now, though, because they stopped at 4. Stopped at 4. We only have daily and weekly. But we do have other time frames in which you can capture these markets in your expectations, but also just know what's available at that time. And also make sure that whenever you're trying to capture your expectations, you're using the right time frame, to do so in the best possible way. All right. So that's really a binary. All right. That is a binary option. You got your in the monies, you're at the monies, you're out of the monies. You understand the buy side. You understand that 0 to 100 scale. You understand, what your maximum loss is, what your maximum profit is. That breaks down a binary option. All right. So what I'm going to do is I'm going to go ahead and move on. I'm going to knock out touch brackets. All right. What do we got here? 25. Cool. So basically with touch brackets, a couple of things I want to address really quickly with you. And that is that they have a lot of differences actually between the binary option. So when I'm going over a touch bracket, I notice that I have a floor and I have a ceiling. All right. They move in linearity. All right. With the underlying market. All right. You have a pinpoint risk control. You have variable payout within this floor. All right. And within the floor and the ceiling. All right. That you're trading within. All right. And as this market moves within this range, okay, you essentially are in a position to where you can trade in and out of your position within that range, right? But with a touch bracket, your position gets closed out whenever your ceiling or your floor hits. So with a binary, it's all about probability, right? It's either going to settle above that line in the sand or it's not. Right? With a touch bracket, you're trading that underlying market within this range, right? So the positions close when the Nadex indicative price touches the floor or the ceiling of the bracket, at which case your max loss and max profit would be achieved, and a new bracket would be take place on the exchange. Now, brackets have a maximum duration of 1 week. Couple of things here, all right? In this example, if I wanted to get into this bracket at 26,130, again, same market we were just looking at, right? The market's at 26,152. Okay. I saying, hey, I know that I have a floor of 2630. I have a ceiling of 26,530. Indices, by the way, they have a 500-point range. The Nasdaq or the US Tech 100 has a 600-point bracket range, and then the forex pairs, they have 250 point or pip ranges. So when you're trading a bracket, it's either a 250 point bracket, it's a 500 point bracket, or if you're trading the Tech 100, it's a 600 point bracket. All right. And the duration of these brackets last a week. So they'll expire on Friday at the end of business, or the bracket closes if your floor or ceiling is touched. And your risk is associated with the distance between the floor and where the market is currently trading. So in this example, if I said, hey, if the market ever comes down to 26,130, I'll be a buyer in this example. 26,130 is 100 points above the floor. Hence, I'm risking 100. I have 400 points that I ultimately can ride up. So 500 point bracket, as is every other indice except for the Tech 100, which is 600. But 500 point range here. It's a $500 total value contract at max value between the buyer and the seller. The buyer in this example here it would be risking around $100 if they got filled at 26,130. If they were to come down to 2630, guess what? Bop, you're out of your position. You lost $100. Why? Because the Nadex indicative price hit that floor of 2630. Your contract would also be closed out immediately if the market went flying up to 26,530 here. So you also would be closed out and lock in your max profit of $400, right? So it's a 500 point scale, $500 scale, right? In this US indice example, this Wall Street 30 example, right? I know my range. Every point that the market moves up, I'm gaining $1 in value. Every point the market goes down, I'm losing $1 in value. But where the price is currently trading relative to your floor, if you're a buyer, or relative to your ceiling as a seller, is ultimately going to determine your risk and your reward, where you are on this in this range, right? Your floor is your protector if you're a buyer. Your ceiling is your protector if you're a seller for loss. and you're trying to go the opposite way for profit. All right. So a couple of things here. I'm going to go ahead and bust out slide 2 for touch brackets. Hopefully you guys can see this. So if you guys go on Nadex Go, which is on your phone, you would actually see these brackets built into the charts. That is coming soon on our charts, but at this very moment, we don't have like the brackets like actually shown on the chart. I can show you there's not brackets there actually showing the floor and the ceiling, but on the Nadex Go app, you would see it. But my point here is that you would see kind of like we have 4 different brackets at all times for all the different markets we have. And by the way, you can trade the 4 U.S. indices, you know, and with the S&P 500, the Dow, and the small cap, all 500-point ranges. And then you got the U.S. Tech 100. So if I just popped over here real quick, oh, not that one, this one right here, you basically see if I go to touch brackets, I got indices, I got my 4 main indices, and then I got my 4 currency pairs I can trade: euro versus dollar, pound versus dollar, dollar versus Swiss franc, and then dollar versus the Japanese yen, right? So you have your 4 brackets there, and you can see how they all have floors and ceilings, right? And where the market's at, these brackets wouldn't exist if that was outside of any of these ranges, because once that floor ceiling is touched, obviously a new bracket comes in and replaces the one that just got touched, okay? So as you can see on this visual, what I was just trying to show you guys and girls is basically you just have these different brackets, right? And maybe the market's here, and just throwing out examples here, okay? But if you were a buyer in this bracket 1, you have low risk, high running up potential, right? And bracket 2, you know, the market's a little bit more in the middle, you know, where the risk and the reward are getting a little bit more similar, and even more so in bracket 3. And then, you know, maybe as a seller in an example, you don't want a lot of risk, you want a lot of room to run down. You know, bracket 4 might be something that you would look into. But any of these brackets you can get into. It really just depends on your situation. So put yourself in the driver's seat and just kind of feel out what bracket is best for you. But ultimately, just kind of understanding this is where the market's at, this is where it's at compared to those floors and ceilings, and how you'd be trading them within each bracket, point for point, dollar for dollar, right? And you have the ability to close out of your position multiple times as well. You know, people go in and, you know, trade the, you know, S&P 500 bracket or the euro versus dollar bracket, and they might trade that bracket, you know, 5 times in one day, because they know that they're making $1 for every point it goes up and losing $1 for every point it goes down if they were a buyer, and vice versa if you were a seller, right? But that's really just touch brackets. A little bit different than binaries. Binaries is about probability of success. Touch bracket has nothing to do with time. It has everything to do with, well, outside of the week expiration, right? It has everything to do with price movement within the range, and you're protected or limited in profit within that floor and ceiling. And then for our last product, it's call spreads. With call spreads, they're actually pretty similar to touch brackets in that they have a floor and they have a ceiling, and they move in linearity with the underlying market. So just like with touch brackets, you know, it's going to move along with that underlying market. The same with spreads. You have pinpoint risk control. Again, you have the ability to kind of enter in at any point in time in this floor and ceiling, right? And as the market moves up and down, so is the value or the risk of your contract, right? Within this range. If you're a buyer, you're protected by that floor. If you're a seller, you're protected by that ceiling, for as far as a maximum loss and a maximum profit is concerned. It still provides that built-in plan for every trade, and it has that variable payout within the range. So very similar to brackets in that regard. Where I think it makes a bigger difference is more so that the position is not closed when that Nadex indicative price touches that floor or ceiling. So with that bracket, you're knocked out, you know, when that floor or ceiling is hit. With a spread, you do have that playability of time on your side, right? In the sense that, for example, the market goes below the floor of 26,100 and I got in at 26,170, right? Here I am risking $70 because I'm 70 points above the floor, right? And let's say this market goes below 26,100. Well, with a bracket, you'd be knocked out, right? You take your max loss, that trade would be done. With a spread, you'd still be in your trade. Now your contract would be, probably not worth that much, maybe zero, maybe $1 or $2, right? But you're still in play. The game's still going, right? You're still in the markets. You still have the ability for that market to come back within that range and create value. Okay. And that is really the main difference, as well as I'd say the other major difference here is that spreads have a maximum at this moment, have a maximum duration of 1 day. So we don't have like spreads for a week at this time. That may be changing here in the future, but right now at this very moment, we have spreads for a maximum duration of 1 day. Brackets expire in a week or until that floor or ceiling of that bracket is touched. Spreads are different, like I said, in binary options, is that there's that variable payout, right? You don't have that variable payout with a binary, right? You can close your position with a binary, but ultimately it's all about probability of success, right? And the likelihood of something to occur. Spreads and brackets are all about variable payouts within that range. With the spread, so just breaking this one down, again, if I'm a buyer, I'm protected by that floor, 26,100, I'm 70 points above it. I got $70 to lose max. I have 330 to gain on the upside. If I was a seller, you just flip that on its head, right? I'd be risking $330 or so, and I have about 70 to make. All right. Another thing about spreads, and if you guys have any questions about this, I'd feel free to, I'm more than happy to answer them after the webinar. But spreads do have a little bit of time premium, particularly at the edges. So if you think about it, like you're trading, there's a buyer and a seller and a contract. And if you were really, really, really close to the floor, let's say the market was trading at like 26,101, you got to ask yourself, well, that's great for the buyer, right? Because they have, in this example, 399 points to run up and only 1 point to go down. But you got to ask yourself, like, well, why would a seller want to ever shake that person's hand? With a bracket, you're out of the trade because the floor or ceiling was hit. With a spread, there's still that time element there, right? So when you get towards these edges, without getting like into crazy detail, I would encourage you to check it out yourself. If the market was at, like, let's say 26, 98, 26,098, there still might be like a $6 or $7 or $8 offer, for this contract. Even though it's below the floor, you're still paying a little bit more because you still have that time premium of this market to go all the way up within that range. Whereas a seller, they're not even in that range yet, right? So the seller, just more towards the edges, you have a little bit of time premium there. If I was a seller really, really low towards the 26,100, I'm risking a lot to make very little. But as an example, my bid might actually be higher than the current indicative price, which means that if the market actually just stayed where it was, and you can kind of see it a little bit here, you see how in this example, the seller, the bid's 26,166, it's almost equal to this price. Whereas the buyer is risking 4 points higher than where it's at. There's that time premium coming into play, okay? Seller doesn't hardly have to have it move at all. Buyer needs to make up 4 points, but they also have a lot more room to run. So that's a little bit more of a difference between how a spread works with a touch bracket, okay? Another thing about call spreads, and this is such a boring slide, I apologize, but this is super old school. But at the same time, I think it does a good justice on like the different spread ranges that we have. So old slide, but just understanding that on Nadex, we have different spread timeframes. We have narrow spreads, we have wide spreads, we have spreads that are 100 points in range, we have spreads that are 250 points in range, we have 500-point spreads, and then we have spreads that are 800 and 1,000 points in range. So very, very large spread ranges, very, very small spread ranges where you still have that floor and that ceiling, right? But you want to make sure that you choose the right spread in the right time frame if you're looking at trade spreads to make sure that you're based on your expectations, it fits you. So you'll see here just how, okay, the market's here. Well, I might have a couple of 2-hour contracts I can trade. I have a couple of maybe 8 hours that I can trade. I have a daily that I can trade. And relative to where the market's currently trading, right, you can currently see actually where it's at within that range and how your risk and your reward would essentially, be different relative to what floor or ceiling you're choosing. Okay, so that just kind of gives you a little bit of a better expectation as to like how spreads function in that regard. Okay, realistically, that pretty much wraps it up. I mean, when you think about it, I'm going over a lot there. We're at about 40 minutes right now. Biggest thing I can say here is that you have three main products here at Nadex. You have binary options, you have spreads, you have touch brackets. They're all pretty awesome. They're all within a week in range, a spread currently within a day or less. You got 5-minute time frames, 20-minute time frames, 2-hour time frames, daily and weekly. So you're either day trading or you're swing trading. You're trading forex and future, forex or indices futures or commodities futures markets, and you're using these products, as a tool on your belt, to get the best circumstances based on your expectations within a time frame and based on where that market's at within a range for a bracket or a spread, or drawing that line in the sand with a binary option scaled at $0 to $100. What I would encourage you to do, whether you've traded here before or whether you haven't, especially if you're just getting started, I'd encourage you to open up a live, open up a demo account, follow us on Twitter at Nadex. We give a lot of great information there. I do updates with my colleague Nick all the time, every single day. We put out some good, fun information on there. Start dressing yourself up to have the best chance for success. We went over part one. We went over the platform layout. You should know how to actually use the platform now as far as like getting into a trade. Now we've got these products down, right? So we're going to put all of this together tomorrow, right? We're going to know the products. We know the 3 types of products that we have, and it might take a couple hours on the demo to get yourself used to it. That's okay. It may take a couple trades in the live to get yourself used to it. That's okay. All right, but wherever you are, you're here to do one thing, and that's to make money on the risk that you put down, right? And I want every one of you guys to be as successful as possible. So hopefully you have a little bit of a better understanding of how binary options work, how spreads work, how touch brackets work, how they're different from one another, when you might choose a binary over a touch bracket, when you might choose a touch bracket over a spread, right? When you might choose a spread over a binary. It's just knowing these a little bit better. And hey, I like this market, I like this time frame, I think it's going to go up, or I think it's going to go down, or I think it's going to stay flat, or I think it's going to go bonkers and go up or down, and I want to trade on that volatility. Make sure you have a good understanding of those products, and hopefully you do now to get yourself dressed up to have the best chance for success. Guys, check in tomorrow. I'm going to be rocking this out, part 3. We're going to do it 6 p.m. Thursday. Tomorrow night, we're going to bring everything together. We're going to talk about the charts in depth. We're going to go over some indicators and some overlays. We're going to set up some theoretical trade examples and just kind of take the products that we've learned, take the platform that we know how to use now, learn more about charts, and then really put everything together. That way you guys hopefully can have a little bit more confidence in your understanding of Nadex, the products, the platform, the charts that we have here. Ladies and gentlemen, I really hope you guys enjoyed this session. Thank you for committing some of your time to your new craft. I love it. I think trading's so cool. I wish the very best for all of you. Get involved, get in the game. You're setting yourself up to have the best chance for success. If you guys have any questions, feel free to stick around. Otherwise, this will conclude our session for today. Again, thank you guys for joining. Have a wonderful evening.